Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden truths behind the corporate world's most important documents. And today, Clean Harbors Incorporated is airing out some very important financial laundry. Let's dive right into what Clean Harbors Incorporated has been up to, specifically about some big money moves they've made, a significant financial strategy that could really shape their future. So, on the 9th of October of 2025, Clean Harbors Incorporated announced they issued a hefty sum of debt. We are talking about $745 million worth of what they call 5.75% senior notes that are due in 2033. Now, what does that mean for the average person? Think of it like this, the company is borrowing a lot of money and they promise to pay it back with interest. This particular borrowing has a set interest rate, 5.75%, and they have to pay it all back by 2033. And why did they do this? Well, a big part of it was to pay off other debts. They used some of the money from these new notes and a lot more from another borrowing. We read talking about $260 million from something called an amended credit agreement. Together, these funds, they paid off about $1,457.3 million of their old debts that were secured by their assets. This is like swapping out an old, perhaps more expensive loan for a new one that might have better terms or lets them manage their borrowing costs more effectively. The plan is to use the rest of the money from these new notes, plus some cash they already have, to buy back their older 2027 notes, which are currently at $545 million. They are planning to do this buyback on the 31st of October of 2025. This is a strategic move to manage their debt profile, potentially reducing their overall interest payments in the long run. It is important to note that these new notes were not registered with the Securities and Exchange Commission, or the SEC. This means they were offered only to very specific types of investors, like big financial institutions that are considered qualified buyers. They can't just sell these to anyone. Now, let us talk about the nitty-gritty of these new notes. They were issued under what is called an indenture, which is basically the contract that lays down all the rules. This indenture was signed on the 9th of October 2025, and it details that these notes are senior unsecured obligations. This means that if the worst were to happen and the company had to declare bankruptcy, holders of these particular notes would get paid back after those who hold secured debts. Payments of interest are supposed to happen twice a year, on the 15th of April and the 15th of October, starting in April of 2026, and they will keep paying this 5.75% interest until the notes are due in October of 2033. The indenture also comes with certain promises or covenants that restrict what the company and its subsidiaries can do. For example, they are limited in how much more debt they can take on, or how they can pay out money to shareholders. They also have restrictions on things like selling off parts of the business or making deals with companies they are affiliated with. These are standard measures to protect the people who lent them money. However, there is a silver lining in these restrictions. If the company's credit rating from two of the major rating agencies gets upgraded to what is called investment grade, some of these limiting rules, especially about taking on more debt, will actually stop applying. This is a strong incentive for the company to perform well and maintain a good financial standing. Also, if something like a change of control happens, which means the ownership or management of the company drastically changes, they might have to offer to buy back these notes from the holders at a slightly higher price. This is a protection for investors in case the company's direction changes unexpectedly through an acquisition or a major leadership shift. The company also has the option to redeem these notes early. Before the 15th of October 2028, they can buy them back at a certain price plus a penalty, sometimes called a make-whole premium. After that date, they can also redeem them at specific prices outlined in the agreement. Interestingly, they can even use money from selling stock, up to 40% of the note's value, to buy some of them back before October 2028, but at a slightly higher price of 105.75%. The agreement also outlines what are called events of default. These are basically breaking the rules of the agreement, things like not paying back the principal or interest on time, failing to pay other important debts, or certain financial troubles like bankruptcy would trigger these defaults. There are also usually grace periods to fix these issues before serious consequences kick in. Moving on to another significant financial move, on the same day, the 9th of October 2025, Clean Harbors Incorporated also entered into an amendment and restatement agreement for their credit facility. This is basically like updating and redoing their existing big loan agreement with banks. Through this amended credit agreement, they secured a new set of loans called new term loans. totaling $260 million. As we mentioned earlier, this borrowing, along with the proceeds from the new notes and some of their own cash, was used to pay off all the existing term loans. These new term loans will mature on the 9th of October 2032. They can be paid back early without any extra fees or penalties, unless they do something called a repressing transaction before the 9th of April 2026. In that specific case, they would have to pay a 1% penalty. The company S promises under this agreement are backed by almost all of their domestic subsidiaries and are secured by liens, which means they put up a lot of their assets as collateral. This makes the lenders feel more secure. The interest rate on these new term loans can be chosen by the company. It can either be based on something called term SOFR, which is tied to a key benchmark interest rate in the market, plus a 1.50% margin, or it can be based on the US base rate plus a 0.50% margin. This gives them flexibility to pick the option that is most favorable, depending on market conditions. Just like the note agreement, this amended credit agreement also has typical restrictions. These covenants limit the company's ability to take on more debt, put liens on assets, make certain payments, or engage in deals with affiliated companies. Basically, they are agreeing to manage their financial operations within certain boundaries to ensure they can repay their lenders. All this information we have discussed about the new notes and the amended credit agreement essentially confirms that Clean Harbors Incorporated has taken on new financial obligations. They've issued new debt and also updated their existing borrowing facility. This is where these new direct financial obligations are being officially reported to the market. And finally, the company has provided us with the actual legal documents. These exhibits include the indenture for the new notes and the Amendment to 40 Restatement agreement for their credit facility. These are the contracts that lay out all the fine print of these major financial decisions. So looking at the big picture here, what is Clean Harbors Incorporated doing? They are essentially overhauling their debt structure. They are taking on new, long-term debt in the form of these senior notes, and also a significant amount in term loans. The primary goal seems to be refinancing older, perhaps more expensive or restrictive debts. This is a move that can be very beneficial if managed correctly. It can lower their overall interest costs and give them more financial flexibility. However, taking on more debt always comes with risks. The company needs to be sure they can generate enough cash flow to comfortably make these payments for years to come. The covenants in these agreements are designed to prevent the company from getting into too much trouble, but they also mean less freedom for the company to act quickly if new opportunities or challenges arise. The fact that some covenants can be waived if they achieve investment grade ratings is a key point. It shows they are striving for financial strength and stability, and achieving that would unlock more operational freedom. The early redemption options also signal that they want to be in control of their debt obligations and are looking for ways to optimize their capital structure. Overall, Clean Harbors Incorporated is making some pretty bold financial maneuvers here. They are clearly focused on optimizing their debt and setting themselves up for what they believe will be a stronger financial future. The success of this strategy will hinge on their ability to continue growing their business and managing their expenses effectively to meet these new obligations. It is a calculated risk, and we will be watching closely to see how it plays out. Alright, that is our breakdown of Clean Harbors Incorporated's latest significant financial moves. What is your take on these strategies and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord link in the description for more community discussion. Thanks for watching, see you next time.